Welcome back to Bloomberg's The Open. I'm Matt Miller. That was ECB President Christine Lagarde speaking from Frankfurt after the ECB cut rates, but also raised its inflation forecast, which I think is quite interesting. Lagarde was adamant that they are still focused on taming inflation, though she refrained from using the phrase break the neck of inflation, which she previously had used. They now expect 2.6% inflation this year, 2.2% next year, and getting back to a reading of 2% in 2026. Let's take a quick look at the markets. If we see the euro, you'll notice it's still 108, just like it has been every day for the past few weeks. In terms of bonds, they are down with yields rising. Whether you look at bunds, whether you look at Italian, French bonds, you can look at treasuries. And because at least tied to this hawkish cut, as some have called it, we see yields rising as the price falls. Let's take a listen to Madame Lagarde talking about cutting or taming inflation, I should say.
Are we today moving into a dialing back phase? I wouldn't volunteer that because, as I said, we are making a decision on the basis of the confidence that we have that we are on a path. We know it's going to be a bumpy road, let's face it. The next few months will continue to be bumpy.
Joining us now is Bloomberg's Lizzy Burden. She is in Frankfurt at the ECB headquarters. And Lizzy, kind of a muddled explanation as to why bother cutting at the same time as lifting your inflation forecasts. I mean, they won't even tell us the cadence, the path ahead. Why reduce the deposit rate now?
A real head scratcher, Matt. I asked myself exactly the same question. Christine Lagarde just walked past me, actually, and if you couldn't zoom in on it, she was wearing a necklace that said "in charge." I think the questions and the filibustering in the press conference perhaps suggest others thought otherwise. But yeah, this is a historic day in any case, that they have cut rates before the Federal Reserve for the first time in history. But the main takeaway is, as you say, how can they be cutting rates at the same time as raising inflation forecasts for both 2024 and 2025? The way she explains it is that it's because confidence in the path ahead had been increasing in recent months. She said it was a unanimous decision, bar one governor. But many are going to be asking, Matt, whether this is a policy error, which is, of course, the same fear that's holding the Fed back from cutting its own interest rate.
All right, Lizzy, thanks very much. Lizzy Burden will be reporting to us from Frankfurt from the ECB throughout the day. It's a very fun job, and there's a delicious restaurant across the street. I recommend going over there and getting the Wiener Schnitzel. I want to point out that we have, the screen here of the rocket. You can see there. The SpaceX Starship, of course, lifted off just about 50 minutes ago with a super heavy booster. They then separated and they're falling down to Earth. Separately, they won't land. They're practicing. This is a fourth test run. Ed Ludlow has been giving us his expert take on it all morning and will continue to do so. I just want to point out they will both splash down in the Indian Ocean. So the hope is that they both splash down in the Indian Ocean. Last time, of course, the Starship disintegrated in the atmosphere, and the hope is that it gets through the atmosphere and then splashes down in a softish way rather than just a hard splashdown. Eventually, they're going to land that and reuse those boosters to launch payloads, and hopefully, I think the end goal is get to Mars. So we're going to continue to follow this as they splash down in the Indian Ocean. I want to, though, continue our conversation on the ECB right now. Let's bring in Alessio De Longis, head of investments at Invesco Solutions. Alessio, thanks for joining us. I'm sure you watched the Lagarde presser. They're fascinating stuff that the ECB feels it necessary to cut rates even when they have to raise inflation expectations. Why bother?
Well, I think if we listen carefully to what she said multiple times, maybe it's a bit less of a head scratcher. For those like you and me, Matt, you remember how monetary policy used to work before 2008. And the simple fact that the 2026 forecast is actually at 1.9%. In the pre-GFC monetary policy way of doing things, would have led to an interest rate cut. It's true that in 2024 and 2025, the forecasts have gone higher. But what I'm reading between the lines is that we are returning to a traditional way of thinking about monetary policy that is really centered on the 2-year forecast and really calibrates each rate hikes or rate cuts around that 2%, 2 years out rate forecast. In other words, was this a policy error? I don't think so, but maybe what they are implying is that the September hike, the last September hike, was probably a policy error in the context of today.
I can understand, Alessio, also, I mean, the idea that as I approach a stoplight, I let off the gas before I go to the brake. It's kind of reversed, but I'm sure you get where I'm going. However, I don't get why they won't lay out the path forward. Why not, give us the cadence or give us an expectation as to when the next cuts are going to come?
I think in my mind, because they are struggling with the fact that actual inflation is still about that 2% at 2.6% and recently rising. Service inflation, which is a little bit more sticky, has risen even a little more than what they would deem comfortable. So I think they are compromising and not overcommitting. But if you look at also her reluctance to commit to a neutral rate, it means that we are in the right direction of travel. We are at 375. I would place the neutral rate with no ambition of being accurate, especially if the ECB is not comfortable. I certainly cannot attach too much comfort on that. But somewhere around 2.5%, 3% is probably what they would consider the neutral zone. And what they suggested is they are still so far from it that probably is better to take it slow now and not overcommit.
What do you make of a rise in yields? Obviously, they've come down, Alessio, substantially. And, she's told us in the past, it's not her job to keep Italian yields in check. Rising around the world on this, what a lot are calling a hawkish cut.
It is a hawkish cut, and in my opinion, rates are rising also because simply we have removed this event risk. What I mean by that, if we look at the data, GDP growth is likely to accelerate. Earnings revisions are improving even in the Eurozone. GDP forecasts from the ECB have improved. So we may actually find ourselves, and I think this is the more awkward part of the timing of the cut rather than the inflation piece, is that we're actually raising rates at a time where the Eurozone may see a cyclical rebound, and therefore that's a little bit more of the head scratcher in my mind. Rates are rising because the economic outlook is actually improving, and now this policy cut event risk is out of the way.
So are we in kind of a not too hot, not too cold Goldilocks scenario, Alessio? I mean, we're right around the level that they want to be. I guess we're still restrictive if above the neutral rate. Oil prices, I mean, she mentioned energy a lot there, are just expected to hover right where they are. I think their forecast is for $83 and change this year. It comes down to 78 next year, 75 in the year ahead. And we're right around there with oil now. So are we in kind of a Goldilocks period for the Eurozone economy?
We are, and we are generally for the global economy. Growth is below trend, but far away from any recessionary levels. So in the developed world, we're growing between 1% and 2%. That is really the perfect level of growth. And on an gradually improving trajectory, that is the perfect level of growth to wait and see and let that inflation path gradually come down while navigating the risks, as you suggested, that we may get the occasional shock from energy prices, or we may get the occasional shock from unexpected base effects. So it is an environment that is very supportive of risky assets. Risky assets continue to do well. We maintain an overweight position in equities relative to fixed income and maintain overweight credit exposures globally, despite credit spreads being very tight. It's still an environment where investors can get paid to harvest higher risk than otherwise.
Alessio, thanks so much for joining us. Great to have you watch the ECB press conference along with us. Alessio De Longis there is head of investments at Invesco Solutions. Now, we got U.S. data as well this morning. Jobless claims are out a little bit higher than had been forecast. Mike McKee, our international economics and policy correspondent, joins us for more. And of course, Mike, this comes ahead of the all-important non-farm payrolls number tomorrow.
And the all-important Fed meeting next week, Matt. And it's interesting because the Bank of Canada has cut rates, and now the European Central Bank has cut rates. But markets don't think that's going to affect the Fed at all. They move forward the idea of a rate cut to November, but after the ECB and Bank of Canada and the data we got today, there's been no real movement there. And maybe that's because it's hard to know exactly where the U.S. is. You mentioned jobless claims. They did rise on a seasonally adjusted basis. But if you look at the non-seasonally adjusted number, the raw number, they fell. So what's the real story? It appears to be that we're not seeing people being laid off, suggesting any kind of major issue with the labor market. Productivity came in a little bit weaker, but unit labor costs fell in the revision to first quarter numbers. There's a sort of opposites for you to try to figure out as well. Trade balance also comes in a lot bigger than the prior month, and that suggests slower growth in the second quarter, except that a lot of that was due to rising imports. And if we're buying a lot of stuff from overseas, maybe the consumer isn't done yet. So a lot of contradictory things for the Fed. You mentioned the jobs numbers tomorrow. This, of course, is the big thing. 185,000 is what the Bloomberg Economist consensus is. The whisper number, though, for the first time in a long time, Wall Street's thinking weaker, 168,000. No change in unemployment, no change in average hourly earnings. Join us at 8:30 Wall Street time tomorrow morning, and we'll give you the numbers.
Absolutely. And if you have a Bloomberg terminal, of course, you can play along at home. Just type WHIS GO to put in your guess for non-farm payrolls. Mike, thanks for joining us. Mike is the Bloomberg International Economics and Policy Correspondent. We'll hear from him again, well, more throughout the day, and then again, of course, tomorrow at the all-important NFP release. Let's talk to Stephen Wieting right now. He is Citi Global Wealth's Chief Investment Strategist and Chief Economist, and I believe right now interim Chief Investment Officer as well. Writing in his mid-year outlook, he says, after holding up well in early 2024, the global economy is regaining strength and may grow into 2025 and beyond. Steve joins us right now. Great to get a chance to talk to you after you released this mid-year outlook, Stephen. What do you think about, the main driver seems to be AI this year. It was the main theme last year as well, and we've gone pretty far pretty fast. Is it not too late to get on board with this?
Well, it's our only area of boom in the economy where there's just massive increases in spending. It's about 12% of all technology spending all of a sudden. We think that there are a lot of areas that are beneficiaries of this. Think about the industries that serve the semiconductor producers, the equipment makers, for example. Think about the energy and the equipment that's needed to produce these data centers. But I think what you just talked about for a while there in Europe is important too, that there's a broadening out in profit growth across the world. Last year, if you took out the Magnificent Seven companies, EPS fell about 7% last year across the world. In the US, 6.5%, ex-Mag 7. So there were many sectors, many industries that were suffering while employment growth was strong. Our call is that employment growth is slowing down. It's partly about productivity, it's industry composition, but profits are picking up around the world, and you don't need to limit yourself to a few tech companies, I think, looking forward.
And of course, you are Citi Global Wealth. You're looking at all areas of investment, all regions. Is the U.S. still, the best game in town? Because obviously we have leadership in technology. We have leadership in AI. Other indexes, for example, in Europe, just don't have that much of a weighting. Are they going to see as much progress? Are we going to see a broadening out?
I think we're going to see a broadening out, and it's not all or nothing. If you think about our large cap tech companies in the United States, you can hold these positions. But we think that mid caps, small caps, think about healthcare, just like technology. This is something that is getting a larger and larger share of global profits, and it's at a discount to its long-term earnings contribution and its forward contribution. So there's more than just tech. And we're not expecting anything like US valuations out of Europe. But when they're swinging from profit declines to gains, we can broaden out and diversify portfolios without giving up as much of the return. Last year, the fewest number of companies could beat the S&P 500. If you take a look at the breadth reading last year, and you put a portfolio together, it was extremely hard to beat the S&P 500. The breadth was the narrowest since 1998. We think it's on its way to picking up now and seeing it this year, even while there's some strong contributors in large cap tech.
Is your bullish outlook dependent, Stephen, on rate cuts? Obviously, we just saw one from the ECB, the Bank of Canada yesterday. The BOE is expected to cut in a couple of weeks. And these come at a time when, it's a very difficult time for the world. A long, ongoing hot war in Ukraine, a hot war in the Middle East, a cold, at least cold relationship between the U.S. and China.
So I wouldn't look at it as rate cut dependent. It is dependent on continuing economic expansion and profit growth. Now, I think what you just saw out of the ECB is an appropriate forward look at what conditions will show. Just 2 years ago, the Eurozone had a 10% inflation rate. Now we're quibbling over whether or not it's 2 or 2.1 when you look 2 years out. But they're thinking about where conditions are going, and it's the labor market that's been very strong. Now we're seeing trade pickup. We are seeing profits pickup that are related to these industries. Now, you did mention conflict zones. We have always seen multiple conflict zones. It's fairly rare, as you could read in our updated wealth outlook today. Less than 10% of all cases beginning in World War II have we seen the world economy change its direction because of geopolitical shocks. So we can't ignore all of these other things while we have to consider these risks. And of course, those risks can multiply, and we understand that. But this is also the time when we're paying nearly historically record low hedging costs for appropriate investors.
We're getting investors, especially retail investors, I think right now are happy that they're getting actual returns on cash. Interest rates, of 5% and more on CDs is where people want to put that money. And I always hear about the cash on the sidelines. Have been hearing about it for 20 years. But Goldman Sachs is out today saying there's a wall of money pouring into the stock market in early July. They write the new quarter, the Q3, and the new half year, second half, is when a wall of money comes into the equity market quickly. Are you a believer that retail cash is enough to pump up markets even more?
Look, I believe in the fundamentals, and I think that last year we were quite depressed with everyone believing accelerating inflation and recession at the same time. We're not expecting to repeat the returns of the last 6 months. 16% for the S&P 500.
Oh.
We do think that there's a lot of catching up opportunities below the surface.
Okay.
And we don't believe that these short-term interest rates are going to endure.
I've got to cut you off there, Stephen, because we're about to see the rockets, the booster and the Starship splash into the Indian Ocean and the Gulf of Mexico. I want to bring Ed Ludlow in, Bloomberg Technology co-host. Ed, we're seeing a lot of cheering there, so I guess it was successful?
This was an outstanding success for SpaceX, and it represents progress in the Starship program. We kind of missed the magic moment, but what they did was a controlled re-entry of Starship into Earth's orbit. Old-fashioned kind of rocketry where a mix of old-fashioned rocketry and modern-day rocketry where you use air resistance to slow down the Starship craft as it passes through Earth's atmosphere, but also the Raptor engines on the base of Starship to kind of reorient it. For lots of that process, we didn't have a clear visual. There was a camera feed, but debris and ash was covering the lens. But because the Starship spacecraft is fitted with a Starlink receiver, SpaceX, even despite just like insane temperatures surrounding the spacecraft, were able to maintain the feed. But what gave SpaceX confidence that it was all going to plan is that even when the camera cut out, there is data feeds on the right-hand side of the screen which show the speed of descent slowing and the altitude reading. And the fact that they were able to constantly get that data was a sign that everything was valid. The goal of this test, the fourth flight test, was to work towards reusability. So you're completely right. In this instance, the Starship spacecraft touched down in the Indian Ocean. It was basically a controlled splash or a controlled dunk. Earlier, about an hour ago, the Super Heavy booster, the actual kind of rocket part that sent the combined system into orbit, had a controlled splashdown in the Gulf of Mexico. I think I incorrectly said on air earlier it was in the Indian Ocean as well, but it wasn't. It was in the Gulf of Mexico. These are all about data gathering, right? And there'll be loads of our Bloomberg Television audience around the world that are saying, well, what are you talking about? They dumped both parts of the Starship system into the ocean. They will try to receive and revive and salvage those parts. But really the value of these exercises is, one, gathering the data. You know, what the Starship craft was able to do is reach orbit, travel around the world at orbital velocity, re-enter in a controlled fashion, and then touch down, albeit a splash, in a controlled fashion. The next goal for SpaceX is to increase the cadence of launch. This is an incredibly powerful launch system. And so we wait and see when they get their next license and go again. But for now, a big success for SpaceX and Starship Test Flight 4. This is Bloomberg.